This will be kind of finishing up our discussion on budgeting that we did last week. It's relatively short. Remember, we talked about the master budget and we talked about flexible budgeting. And in Chapter 7, we talked about flexible budgeting for direct costs. Here we'll talk about it for overhead costs. Pretty much in every section there's one or two key points. The key point to take out of this section is when you look at variances related to indirect costs, you need to treat them with care. When you have variances related to direct costs, you should be able to identify the causes, work your way down, say, oh, we paid too much, or we have problems with our machinery, and take corrective action. With indirect costs, since they're being allocated based upon some other allocation basis, let's say direct labor hours, you could have a problem with your direct labor hours that's resulting in a problem with the variance on your overhead for your overhead costs. So the problem is not in the way you're managing your overhead, it's the way you're managing your direct labor, since that was your basis. And that's the key takeaway from this unit. But let's go through it. We'll distinguish between product costing for accounting purposes and production control purposes. We'll show how to calculate standard cost variances, and then we'll talk about standard costs in service organizations. So, in the overall variance analysis, we're really just focused on variable factory overhead and fixed factory overhead. And for each, they would have a spending and an efficiency or a production basis. And remember, we've already talked about applying your costs. Application is different than variance, and we'll talk about that. Going back to, I think, the first week, reminding ourselves that overhead has variable components and fixed components. Variable components could be energy costs. They're based upon how much you're producing, so how much you're using your machinery. Some indirect labor and materials, you'll maybe need more supervisors if you can have a second or third shift. So it's based upon, it varies with production levels. Fixed overhead are really those things that doesn't matter except unless you have significant changes in volumes, you have to build a new factory. But if you just within the same factory doing the same work, these costs tend to stay fixed no matter what your volumes are. Remember, like I said, the allocation precision is based on the quality of the allocation basis. If direct labor hours aren't an appropriate measure for your overhead, then the basis is wrong, your allocation will be wrong, you'll have variances. So you want to have, hopefully, some kind of a cause and effect between the basis and the overhead category that you're allocating. So for a manager's salary, maybe direct labor is a reasonable basis because managers' salaries, you may need additional managers as you increase your staffing levels. So remembering that in standard costing systems, if you had a standard costing accounting system, you will be recording overhead costs as they occur based upon your allocation basis, as they occur. But of course, you need to absorb all those costs correctly for GAAP purposes at the end of the period. So you then need to handle those variances and correct them out and have them reflect the actual overhead costs that were actually spent, no matter how you are allocating them through the life of the period. So remember that since GAAP requires absorption costing, you need to do this variance analysis and you need to correct it at the end. That doesn't mean you can manage off of it. It just means you have to do it for accounting purposes. So for variable overhead, it's pretty much what we've seen before. It has a spending and an efficiency variance, and you flex it in between by keeping your actual quantity of whatever your basis was, direct labor hours, let's say, and your standard rate. From that, just visually, this shows that your total costs will have a spending variance and an efficiency variance. Let's go through an example to kind of bring this to life. Schmidt Machinery, I think we talked about them last week. It's a continuation of the same model. We know that there are 5 standard direct labor hours for every unit of goods sold. That's your standard. And your standard overhead rate is $12 per direct labor hour. So your standard overhead rate is $60 per unit. You have actuals, $35.10 in hours, and you made the 780 rather than the 1,000 we thought we were going to make. And our total actual variable overhead for the month was $40,630. This goes back to our standard costing sheet, which we saw last time. This is the line we're looking at here. 5 hours, $12 an hour, $60 per unit. So for each unit, as it's produced, it's absorbing $60 of overhead. So let's look at our variance analysis. It's all based upon what we had. So first you have your actual hours times your actual rate. These are your actuals and actuals. We said there were 35.10 hours, and we spent $40,630. That was given. So your actual rate was $11.57 and change. This times this gets you to $40,630. That's your actuals and actuals. Our standard, we produced 780 units with a standard of 5 direct labor hours per unit, which is 3,900 units was our standard, and our standard rate was $12 an hour. So we would have expected in this period to have had 46,800 in cost. That was our standard cost for our variable overhead. We flex it in between. We use the actual hours, same as here, 35.10, and our standard rate, same as here. So at the actual hours, we would have expected to have spent $42,120, and so from there you can then break it down to a spending and an efficiency variance. The spending variance was both of them favorable, was $1,490, and our efficiency variance was $4,680. Very similar to what we did for direct labor and direct machinery, because it's variable, and therefore we can do the same thing. How do we interpret this data now? The interpretation is different than it is for direct labor and direct machinery. The spending variance. So the spending variance was favorable here, and it was based upon a favorable rate, right? That's really what caused the favorable variance. So this is good information for you. If it's favorable or unfavorable, you may want to analyze it and understand it. You could do something about the spending variance. Why did it cost less? Maybe it's a good thing, but maybe you used lower skilled labor or something. So that is worth looking at. The efficiency variance, on the other hand, does not tell you anything about your variable overhead. It tells you about how you use direct labor hours. not variable overhead. So you really can't use this to manage your variable overhead better. But you have to do it so that you properly absorb the cost of variable overhead. But it is not particularly useful as a management tool. So that's variable overhead. Let's look at the fixed overhead now. Same idea. It's not going to be based upon rates. You're not seeing this as a rate times a quantity because fixed overhead doesn't work that way. You just get it. You get the depreciation cost. You get the cost of the security guard, whatever it might be. It's not based upon any volume basis. Similarly, the budget is not based upon rates. It's based upon some predetermined amount that you think it's going to be. Now, this applied, this is what we did before, right? This is what we did in the previous chapter. We apply it as we go so that we can apply it and we have an over-application or an under-application at the end of the period. But you can still have these variances, spending variance and a volume variance, but you have to use them carefully. The volume variance is just so you can allocate your costs to your products correctly. We did this. First, you determine your budgeted fixed overhead for the period. What's your budget? $1 million in fixed overhead. You choose what variable to use to apply it, say direct labor. You choose the denominator level. Let's say you choose practical capacity, how much you can practically use of your direct labor. And then you find your application rate. This is what we did before. Nothing new there. We did this exact problem, I think. They budgeted at $120,000. They budgeted activity for the month of 1,000 units, 5 direct labor hours per unit. Now we'll compute the variances. First thing you have to do is identify the cost per direct labor hour. So they use the budget of 5,000 here, 1,000 units times 5, and they use the budget of 120,000 total cost. So they're expecting $24 per direct labor hour to be their fixed cost that they're going to apply. And this just shows that. So this was given, 120,000. This was given in some way that it actually cost 130,000. Remember we saw that last week, that it cost more than expected. And in the course of the period, we were applying our fixed overhead a little at a time. And but since we only sold 780 units, we under-applied. We only applied $93,600 excuse me. Remember, we were expecting to sell 1,000 units, and we would have applied $120 per unit, and that would have given us this $120,000. But we only produced 780 units, so we only applied 78% essentially of 120,000. And that's what's our applied, so we are under applied. This doesn't mean it's favorable or unfavorable. This U is under applied by 26,400. And we talked about how you have to figure out how to apply this for product costing purposes. This is about as easy a problem as I could do. At the end of the period, that has to absolutely go to 0. And you do, I think we talked about it, you could do it through, and we will talk about it again today, cost of goods sold. You could do it through a few different categories, and you can therefore manage, you can manage your profitability to some degree through that, inappropriately, potentially. So it's an area of risk from an accounting perspective.
Go back and recalculate your labor hours per unit rate.
Would you recalculate this?
Based on the fact that it's
There are different ways of handling it. You wouldn't go backwards in time, but you do have to take this under-applied and allocate it out. Ultimately, this is what has to be, this is what was spent. This has to be costed out. So you have to allocate this out in some fashion. Quite often, it's due to your choice of this denominator. That's what kind of drives the allocation. So what you would do for future periods is rethink this. Why was it so far off? Okay, to do it, it should take about a minute. Calculate the three variances here. To production volume variance, the budget variance, and the fixed overhead variance. The budget variance we also call spending variance. This is your actual. This is your budget. And this is your applied. What's this variance here? Which one is this? The production volume. So this is your production volume variance. 33,000 over applied. You applied more than you budgeted for. What's this one? We're calling it the budget variance or the spending variance. Unfavorable. So this is not under applied. This is unfavorable. You spent more than you budgeted. And then your overall is 17,000. So how do you interpret this fixed overhead variance? Well, this variance between your actual and your budget, there was a question about it last week. I think it was your question. It was 10,000 over. That you want to understand. You want to understand the cause of why did you spend $10,000 more for fixed costs than you budgeted. You should understand that. So that is worth analyzing. This stuff you're doing so that you product cost correctly. It's not a control tool. It's not something you would monitor and try to understand how can we be more efficient from. Because this is essentially based upon that denominator value. How did you choose how quickly you intended to allocate? So the spending or the budget variance could be bad budgeting. Maybe you just didn't control your costs. Or maybe you misclassified some costs along the way. The production volume variance is about accounting decisions, potentially. How did you choose to apply it? It could be due to different demand. That was the Schmidt company was different demand. You thought you were going to produce 1,000, you ended up producing 780. That changed how you applied your overhead. Or possibly a machine broke down and you had to buy a new fixed asset. That could cause it. So this is just the overview of everything we saw there. Again. I'm going to pass on doing this one. So the question came up, what do you do with these variances for overhead? You can, if you deem them immaterial, just put them all in cost of goods sold. What does that do? What's that? What does it do to your profit? It will lower your profit because it'll increase your expenses. Exactly. Sorry, I didn't hear. It will lower your profit. So if you believe it's immaterial, that's the cleanest way. So maybe you want to do that for tax purposes. So you could show and should show that variance analysis as a separate line, or at the minimum as a note. Or you would prorate it between your various inventory accounts and cost of goods sold based upon some formula that you choose. And here's where you could play it. You could choose to put more in inventory, and what would that do? Increase your profits and boost up your balance sheet by giving you, more assets. So how you dispose of your variances will have an effect on your profitability and your balance sheet. And you could do it simply by having a bad denominator level. Now the question is, so we've learned about standard costing. It's an excellent way to force you into understanding your costs. Understand why costs are more or less than you think. Now the question is, in the service industry, is standard costing does it make sense? Let's say a hospital. How would you feel going to a hospital that uses standard costs if you had a heart attack? And they're managing their variances on how they treat you with your heart attack. And you say, oh, can't do any more. We've used up all our costs. We don't want to look bad. So standard costing may not make sense for certain service industries. Because while there is maybe a standard of care that's appropriate, you don't want your service provider to be thinking about that standard of care and no more than that when you go into a hospital.
I have a Canadian healthcare system works, where certain procedures are ratcheted down to the hospital going to
I don't know much. Anybody know about the Canadian healthcare system? Or maybe you do. Yeah. I don't know whether it's true or not. It might have been part of the propaganda concerning the ACA. Maybe everyone's afraid that we'd get to that point. Maybe that's where you heard it. I just don't know. So, last few chapters we talked about variances. You need to decide when to investigate a problem. When is a problem worthy of being corrected? Certainly size makes a difference, both in dollar amount and percentage of variance. The variance is a percentage of a total cost. The bigger the problem, the more likely it is that you should investigate it. If it's happening over and over and over again, that means you're doing something wrong in your budgeting, if nothing else. If there's a trend, you see it getting worse and worse and worse over time in an obvious direction. So maybe you can get it before it becomes seriously bad. Is it controllable? I mean, is this variance in an area that you can change your management in some way so that you can improve that variance and therefore improve your costs? Or is it some kind of a fixed overhead variance that's there just because of accounting and not because of ways to truly change the business? Favorable variances. I add this because you want to look at both favorable and unfavorable variances. If you have significant favorable variances, that could be a flag. What might be a reason for a favorable variance that you'd want to look at? Anybody have any ideas? So that's a favorable variance because of selling in a peak period. Any others? What about a direct labor spending variance being favorable? What could that be? Maybe you're hiring cheaper, less capable labor. You're saving on your labor, or your direct materials variance is a positive spending variance. Maybe you're buying cheaper materials that the problems won't manifest themselves for another year when you get more customer service requests. So a favorable variance might actually be a cause of something you need to look at. And as with everything you do in the business world, cost-benefit. You only do an analysis of the problem if you expect to create value from that analysis. You don't do it just because you want to do an analysis. Another way of looking at it is you look at the variances. If the variances are caused by random error, you can't control it, so why spend too much time on it? But these others you might be able to control in some way, so it's worth looking at them and in some coordinated fashion looking to correct them. Any questions on indirect variances? Indirect variances. Okay, let's do Apple now. I hope that wake anybody up with that. I meant to.